This is the Nedgroup Investments podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you.
Welcome to this special installment of the Nedgroup Investments Multi-Management Podcast. I'm Leandra Temmers. Today we will be reviewing the main investment drivers for the 2019 year, and given that we have seen new and different vulnerabilities coming to the fore, each one equally important and any one of which could lead to market ruptures, we highlight some of the most important themes that are likely to play out in the year ahead. To unpack this further, I have with me Trevor Garvin, Head of Multi-Management at Nedgroup Investments. Welcome, Trevor.
Thank you, Leandra.
There may have been a point this year where it appeared that all the naysayers and doomsday prophets were correct and that the world economy was heading for a recession. But is it fair to say this isn't necessarily the view that Nedgroup Investments multi-managers held in 2019?
Yes, I think 2019 has certainly been an interesting year. I think a good point or area to start off with is actually take yourself back to December 2018. So if we were sitting here this time last year, we were actually expecting 3 interest rate hikes in the US because there was fears that the US economy was overheating and they would need to slow it down, etc. But in the space of 1 month from December to January 2019, that whole view had changed from 3 interest rate hikes to looking at possibly 2 interest rate drops or cuts in the US, because suddenly they were worried that the US economy was slowing down too quickly. And if that was going to happen, it would put pressure on not only the US, but I guess the whole global economy. And that's actually what we saw. We did see a couple of interest rate cuts in the US at the beginning of the year. And since then, it's basically been flat. So that's really helped hold markets strong. We've seen equity markets really shoot up for the rest of the year, and we've seen extremely strong returns across all asset classes, really. So if we look really at equity market returns for 2019 across the board, equities have been up well over 25%, listed properties up over 20%, global bonds is up about 6.5-7%. So definitely the doomsayers, I guess, would have not called it correctly. They would have lost out on a lot of return if they were holding their money in cash. And certainly 2019 probably surprised everybody on the upside in terms of equity market returns. Having said that, looking forward into 2020, we do see things slowing down and changing. We do think global economic growth will slow down from the 2.5% to 3% that it's had this year, probably to 2 to 2.5%. We see the US probably holding interest rates unchanged. If anything, maybe some interest rate cuts going into the second half of 2020. But it all really depends, I think, on inflation that's going to come out in terms of the US.
The US Fed led the charge in cutting interest rates this year, and the developed market economies continued to undershoot their inflation targets. Easier financial conditions were also certainly a boon for the global equity markets, with Wall Street posting all-time highs. Would you agree with this?
Yeah, so I think it talks to probably what we were just saying earlier, is that, markets have continuously hit all-time highs again in the past year, with equities being the star performer. I think the developed markets have actually outperformed emerging markets over the course of the last 12 months. As I mentioned, the MSCI World All-Country Index is up about, I think it's 26-27% in US dollar terms year to date, so as at the end of November. If we also look at the other asset classes like listed property stocks, they've been up extremely strongly as well, 22-23%, and developed market equities about 10-12% over the course of the year. Having said that, I also think that there is increased levels of uncertainty at the moment. And uncertainty creates jitters in the market, business owners cannot plan correctly when there's uncertainty. And overall, generally, that leads to often increased volatility in the markets. And I think this is going to probably be a theme going forward into 2020, is that there's going to be increased volatility. There's definitely increased uncertainty. So in terms of some of the big, of course, issues that are currently at hand is, for example, the US-China trade negotiations. It looks like the US and China will probably sign phase 1 of their trade negotiations, and then it will go into continued negotiations for further phases down the line. In terms of Brexit, of course, has been just this ongoing uncertainty, both for the UK as well as the EU. And in terms of that, we're going to need to see what the outcome is of the UK elections. Should the Conservative Party win, which is probably the likely outcome, they will push through the Brexit deal in early 2020, and then we shall see the next 12 months or so, they have the window to do their trade negotiations with the EU. So again, those trade negotiations, I think, are going to cause quite a high degree of uncertainty, both for the UK and the EU in terms of businesses and trade policies going forward. And then, of course, there's Donald Trump with the US tariffs. In terms of the EU, he keeps threatening to put high tariffs, particularly on the car makers in the EU for car imports into the US. And really that, of course, it can have a big ripple down effect in terms of the large car manufacturers in Europe, particularly in Germany. And we've seen recently the German economy coming under quite a lot of pressure. So, yeah, I think we're in for interesting times. I think returns probably going forward for 2020 will be quite a lot more muted. I don't foresee high 20 returns again. I think we probably are looking at more high single digits in terms of equity and fixed income returns for 2020.
So while we had some impressive returns from developed markets, can we expect to see similar returns in the coming year? And given the upcoming US elections and all the dotting of the I's and crossing of the T's that still need to take place with regards to Brexit even, do you see more volatile times ahead?
Yes. So I alluded to it perhaps in the previous question, in that we definitely see volatility being larger and increasing going into 2020. And with increased uncertainty, we're going to see, as I've mentioned, increased volatility. This probably will lead to more muted asset class returns. But really, I think if we look at sort of our house view as the multi-manager in terms of global markets, can probably sort of summarize it in a few points. So we still see global real GDP growth growing more modestly at a rate of around 2 to 2.5%, which is lower than what it's been in the last couple of years. And we do think that international trade and manufacturing will stabilize and actually towards the end of 2020, perhaps pick up globally. I have mentioned in terms of the US and China trade deals that we think that those two countries will probably sign a phase 1 agreement, and then going into the rest of the year will continue to negotiate their trade deals. In terms of really, I think global inflation is the other key point. We see global inflation remaining on the lower end of the scale, which will really then allow central banks, both in terms of the US and Europe, to keep interest rates low, so easier monetary policy. And of course, this generally has a stimulatory effect in the economy as well as on equity markets. In terms of corporate earnings, we see corporate earnings still continuing to grow positively in 2020, probably at a rate of around about 5% measured in US dollar terms, which is lower than what they have been growing over the past couple of years, but still giving you positive real corporate earnings growth. So if we sort of look at the actual asset classes, we still see equities probably being the best performing asset class for 2020, outperforming government bonds. In terms of the fixed income space, we probably still prefer investment grade corporate bonds and high yield bonds on the short duration side of the curve. And those are really giving you yields currently of probably around 5 or 6%, which we think will outperform government bonds for 2020. In terms of Europe and the UK, we see Brexit probably happening. And as I said, we wait the outcome of the UK elections. But I think that's, although the elections might bring certainty to the actual Brexit happening, it's still going to create quite a high level of uncertainty in terms of what the new trade deals are going to be between the UK and the various European Union countries. So I think investor returns will be lower next year. I think they'll still be positive. And certainly in terms of all of our funds and our portfolios, we still have a good portion in global assets. We are still overweight global assets and global equities specifically. But having said that, we are diversified. So we have holdings across equities, fixed income, specifically in the high yield and corporate bond space, as well as global listed property. And I think it's just a matter of riding it out next year, sticking to your guns, but also remaining properly diversified.
Thank you, Trevor, for your time and for sharing some of your insights with us. That was Trevor Garvin, head of Nedgroup Investments Multi-Management in Cape Town.
Nedgroup Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.